Welcome everyone. I know you guys are here for the good stuff, and we're definitely going to give it to you. Our goal here is to give you enough information to be able to walk out today and actually take some action, do something, um, and really, make some money moves. And I'm not going to lie, I think the first half of 2025 seemed a little questionable for a lot of people and a lot of investors. And the second half, you won't believe is going crazy. And when I say the second half, I mean starting today. So literally starting today, for those of you who know what I'm talking about, things are looking good. The future is looking bright. A lot of those tariff talks have mellowed out. And, we are getting ready to build, obviously, ourselves. Now, if you don't know who I am your host for this call today. I'm also the founder of the FlexSpace network. I also run a real estate fund where we do eight-figure deals, and it didn't always used to be that way. I'm going to get into that a little early, a little later in today's presentation. But I myself self-sponsor, these deals for myself. In fact, I'm building a 30 to 40 million dollar. The reason I say 30 to 40, I know it's a big gap, but we don't know exactly how many buildings are coming into our development. So the number is a little out there, but I'm self-sponsoring basically a 30 to 40 million dollar development. And the interesting thing here is that when I came to this country, I couldn't sponsor probably $1 million of debt. So I needed a lot of help. I didn't know where to begin, and I actually utilized some of the resources that I talk about in order to be able to sponsor my own debt. And that was that. So let me give you a little bit of history. I'm an immigrant. My name, once again, is Hamza Ali. I moved to America in 2014, beginning of 2014. So just over 10 years now. I came here with a couple $100,000 in my pocket. So I didn't actually come here with $0. I know a lot of immigrants have that really awesome story where they come from $0 and they somehow make it, into crazy amounts of wealth. I came here with a couple $100,000. I had sold a business back home, well, this is my home now. But I had sold the business and come here with the ambition, with the hopes of making something happen for myself, doing something big. And I would say I got lucky, right time, right place. And what I mean by that is I attacked the flex space market when nobody else was looking. It was an extremely undesirable asset class. People were not interested in building flex spaces. And in fact, the product didn't even have a name. So it was office warehouses. It was, office/warehouse. It was a warehouse, or it could be called warehouse. It had so many different names at that. What were they called? Large bay warehouses or small bay warehouses. Like it had so many different names, guys. And about 3 or 4 years ago, I decided, you know what, we need to give this product its own asset class, its own name. So I got together the best minds in the world of FlexSpace real estate, and we came up with this FlexSpace network, where now the who's who in the world of FlexSpace, come in and they talk, and we talk strategies and all of that. Karim, just quick question. Did you see the email from Dave today? Do you think it would be a good idea to share that just before we go on the presentation and before we go over today? So we guys received our first, remember I was telling you we're building this 30 to 40 million dollar development. We received our first A&E contract today, May 13th, and with a bid. And if you guys are interested to look at it, just type yes in the comments. And right before I go into the presentation, I would like to share this as a resource for you guys, so you guys know what an A&E contract looks like. And you guys know also who my vendor in Houston is. By the way, my vendor, the thing is, when you're in a network, there's no real reason to hide anything. When you're part of a network, everybody's sharing, everybody's making things better. There's a lot of yeses. Let me see what I can do here. And if I can indeed share this screen, just 1 second. It says documents. Nope. I need to share this screen, I believe, which is this document right here. Preview. Okay. Can you guys see the document?
Yeah.
Karim, you guys can see it? Okay, let me just really quickly run this document by you. So take a screenshot if you have to. This is the vendor that I'm using for who's going to be doing all my architecturals and engineering. And this is a pretty standard, guys, A&E contract. This is sort of what it looks like. It gives you what the scope of work is, what what everything entails. As you can see, okay, Client name, Hamza Invest, that's my company. Near, because we haven't platted the site, so we don't actually have an address. So they've just put an address near, near the property. And then we have what the project scope is going to look like. So here's the date. As you can see, literally May 13th, 2025. That is today's date. And project start date, well, depending if I sign the document, which I haven't just yet, we're going to start on the 27th. So we're really excited to get started on this. It's going to be a huge development. For those of you who follow me on social media, you already know the ins and outs and the things I'm really looking to do with this project. Hold on, let me see if I can actually just open this up a little bit so that you guys can see the entire screen. Okay, so, A&E contracts are extremely important. I would say they are an industry standard when you are working with somebody who is going to be doing your architectural slash civil. They basically come in a template where you can, ultimately add everything that you need to. And over here, what you're going to notice is we have one story, we have basic build outs. We actually do have a mezzanine floor as well. And I wonder if that is added here. It should be added here pretty clearly. I literally received this right before this call, so I haven't had a lot of time to go over it, but this is sort of what this contract looks like. Now, in my case, $107 for, let me give you guys the number of square feet. I believe, if I'm not mistaken, the total number of square footage, if I looked at the email and I remember well, it was like 200,000 square feet or so. So this contract is coming in at about 50 cents a square foot. And this is just the A&E part. Obviously, there's going to be more stuff that comes in after that. I would say a good price point for people who are looking to develop flex. So let's say you're developing 10,000 square feet. That's where I would say most of everyone begins. You're probably looking to pay between $1 to $2. And I know it's a wide range, but there's a lot of variables that come into play. So you really need to make sure that you are doing the right thing when it comes to that. Okay, I'm gonna stop sharing this really quickly, and I'm gonna get with the program because I know I am holding you guys back. Let's see what I can do here and slideshow. All right, guys, we're ready to get fired up. We have 143 people in 145 right now. Okay, so 143 to 145. Let's just call it as it is. And here you go. This is today's conversation. So what is today's conversation? Today's conversation is, obviously, you guys want to get started in Flex. That's why you guys signed up in any capacity. So you guys may be investors, you guys may be developers, you guys may be real estate people who are tired of other asset classes and are looking to venture into something that is a little more simple, a little more scalable, a little more easier to build. And obviously, you can do this at all scales. You can start with one building. You can retrofit an old building, like I saw somebody in the comments had done that. You can also build ground up. Now, when it comes to me, I started my FlexSpace journey about 10 years ago, like I said, when not many people were looking. My total cost of construction plus land was around $50 a square foot. Okay. Obviously, those days are gone, long gone. The demand for Flex has never been higher, and it is continuing to grow, just like AI, right? Everybody thought Nvidia stock is going to drop and go to zero, and here we are at new all-time highs today. And just like that, FlexSpace continues to surprise most skeptical real estate investors and just keeps climbing to the top. Rents have consistently gone up over the past 10 years. And I'm not telling, I have the statistics to prove that, but I'm telling you this from my personal experience that rents have gone up over the past 10 years. Occupancies have remained in the high 90% for me. So like I'm talking 92 on a bad year to probably 97, 98%. And my developments, guys, remember, are larger, right? So I'm building at least 70 to 80,000 square feet, at least at a time. My current development is 200,000 square feet. So for me to have 92 to 97% occupancy at all given times without too many issues is a big deal. Also, I'm just going to quickly add this. My property manager, I met her about 7 years ago, and she works remote. I actually don't know where she lives right now because she moves around, but she works remote for me, and she manages the entirety of my FlexSpace property management. So you can have one manager managing 10 deals. It's unlike multifamily, it's unlike residential, it's unlike anything else because they don't actually have to go to the property to get anything done. Everything is pretty fairly automated. All right, now with that, let's get started. It is May 13th. I believe this is officially May 13th is officially the start of the new year, and this is where a lot of things are kicking off. It just happened to be that we decided to host this webinar on this day, on this very lucky day, and I think here on forth, we're just going to keep growing. And what that means is obviously that we did continue growing. We continue to do a lot of work in 2025. It's not like we stopped, but obviously there was a brief pause because of the understanding of tariffs and what we kind of needed to understand. And as you know, our material comes from all across the world. A lot of it is locally sourced, but a lot of it does come internationally because we like to save on cost, right? Everybody's looking to save a little bit of money on cost and make ultimately the best ROI on the back end. So definitely something to have a conversation about. Okay, so what are flex spaces? In my case, they are multi-tenant, light industrial office warehouses with a small bay. And ideally, what I like to say is they're generally around 10% office and they're around 90% warehouse. So, you know, when I say 10% office, 90% warehouse, this is because not because like I like it that way. It's because the businesses actually like it that way. They need a space. They need an open space to operate out of to conduct their businesses, which there are many, many, many kinds. And I've seen very unique businesses come into flex spaces. And they need a small office to be able to manage either the assembly line or whatever it is that they're doing in there, whether it's fixing Tesla batteries. Yes, fixing Tesla batteries, that is actually a business that FlexSpace operators operate out of. Or whether it's running their e-com businesses, or even in a lot of cases open floor fitness areas, right? So there's a lot of stuff that goes on in these spaces, and this is how people like them. So as you can see over here, I've given you sort of a diagram as to what to expect with these flex spaces. So you have your office here, you have your washroom or your restroom right there. And then you have this portion here that is your warehouse, which is what really your tenants are looking for. That's why they're primarily there. They need that space. Of course, in my case, they're also metal buildings. They're multi-tenanted. So the reason I like flex spaces that are multi-tenanted as opposed to single tenanted is because let's say you build a building, it's 10,000 square feet, you have one tenant in there. For whatever reason, if that tenant decides to leave tomorrow, you're down to zero occupancy. But if you had four tenants in the 10,000 square feet, so 2,500 a tenant, then you're down to 75% occupancy. Well, what happens if you have more tenants? And we'll go over that in just a second as well. And of course, as of more recent, it's a mix of retail and industrial. So it's not just industrial tenants. A lot of people get flex spaces confused and think that, oh, we have a production line and we have manufacturing and we have logistics. Yes, we do have a small component of that, but I would say a majority of our businesses are retail businesses looking for that larger open sort of concept area. All right, I'm going to go over the details here. Some statistics that we get from Colliers. By the way, Colliers is a partner of the network. Any information we need to pull that's updated, they can help us pull it, and they can help us cater to our market. And we pull data from Colliers all the time. It's an amazing group of people, and they are one of sort of our coach level people that also assist a lot of our members. I can't tell you how important it is, guys, to have the data when you need it, and how important it is to have relevant data to your specific markets, right? If you told me, hey, is Houston the best market? I would say yes. But then if you told me, hey, is North Carolina the best market? I would say yes. It just depends on the data, the pocket, where you're investing, what the price point is. There is no market that is a number one market, but there are opportunities all across the country that are number one opportunities. And that is what we look at across the country, even in Canada, by the way. And it's all about the opportunity, right? We need to make sure that the returns are there, and we need to make sure that they're data-driven decisions ultimately. So that's kind of what we look at. Anyways, let's go over this. Average rental rate. This is a little dated, and also it's a little, what do you call it, contaminated, the data, because unfortunately, until very recent, the data on Flex is what happens is we fall under the larger industrial data. And so some of this data is actually not very accurate. So what I will tell you is right off the bat, what I can tell you from here is sales per square foot is actually much higher than 138 for these small bay warehouses. And also REIT owned is significantly less than 26%. So the REITs do not, well, institutional equities do own flex spaces, but REITs specifically, there's not much activity when it comes to REITs. You're probably either buying from private equity, the larger spaces, or you're selling to private equity as well. And that is as of recent. So I would say the last 2 years, we've really seen that activity ramp up. As far as vacancy, I would say 6% vacancy in most cases is relatively accurate. You should expect look, it depends on how big or how small your warehouse is, right? If you have 10,000 square feet, I would say you need 100% occupancy, so 0% vacancy. Yes, I said that right, 0% vacancy. But if you have like a larger development, right, and you have, it's that time when tenants are moving in, moving out, expanding, contracting for their business needs, then at that point you can see vacancy. And I think 6% is actually a pretty good assumption on vacancy. All right, let me give you guys an idea as to where the top markets are and where sort of most people are seeing activity. Now, it is no secret that some states are better than other states, right? If you are in certain states where it is difficult to build, and you come to me and you say, hey, I'm going to build in my state because, it's difficult to build. I know, but you give me the reason, whatever the reason is, XYZ, right? And someone else comes along and says, hey, I'm just going to build in this other state, and it's a better state. It's easier to work with. The county is ready to go. The zoning is easy. It's going to take me 2 months to get my permits, and cost of construction is relatively inexpensive. Out of the two, 9 times out of 10, what's going to end up happening is the winner state is going to win, right? Just because things are easier to do there. And let me explain exactly what I mean by that, right? So first, let's go over net absorption. Houston, number one, Dallas, number two, Philly, number three, New York Metro, number four, Denver, number five. Under construction, Phoenix, number one, Greater Los Angeles, Atlanta, Dallas, and Austin. And then fastest growing, obviously, you can look at that. But like I said, this data is a little, it's a mix between flex and industrial. So some of this data is pretty good. Some of this data, we still need to go in and do further analysis. Like we can't take this information and plug it in and say, okay, this is exactly what's going on in the market. We actually do further analysis. That is, I would say, proprietary, maybe to us. I don't know. I think it is because I definitely invented the process, but then right now in the world of people who are our members, a lot of people use a similar process, but we keep updating ours and keep it fresh all the time. Okay, so now let me walk you through what I mean by some markets are better than other markets, okay? About 5 years ago, I was presented with an opportunity to invest in Austin, Texas. Great economy, great market, but the permitting is known to be a little painful. Like it takes more time compared to Houston, and you need to be patient, right? So we purchased a piece of land. We went with the rezoning. We got all of that done. As we got ready to start getting our permits, to start construction. Unfortunately, those got halted due to a reason for the area and whatnot, and due to certain regulations that the county, or the city rather, had put into place, where it became very hard for us to then cater to tenants. That project we're still fighting our way through. Ultimately, we will get it done, but it's been 5 years or 4 years now, and that project has not really moved. Although the returns on the project, once it's done, are going to be phenomenal. So if I told you, hey, you're going to make 100% return, but that 100% return is going to be in 10 years, so you average it down to 10% a year, that's not really the reason that we're doing this, right? We want to make more, hopefully more than 10%, closer to maybe that 20% a year number. In some cases, maybe even higher. We've had members that do way more than 20% a year, just depending on how fast they complete these developments. Anyways, long story short, Houston, Texas, similar project, okay? Maybe not 100% return, maybe it was like a 70% return, but we got in and out of that deal in 2.5 years because the permitting was easier, the zoning was easier, the county was ready to work. We were able to lease out the development to the right tenants who needed it, right? So in many cases, you really have to look at how easy or how difficult is it going to be for me to build in my certain county. And I love the fact that you guys are from all across the country, right? But the reality is that there are going to be counties that are just going to be or cities or suburbs or whatever it is that are just going to be easier to build than others. Where do you get that information? How do you find out which county is responsive, which county? And I'm not saying that I have the information, but what I am saying is the FlexSpace network definitely will have some type of information, because we have over 600 members in the network, and what they do is they do exactly this, right? They go to check out their development, they gauge counties, and they figure out what is the best place to invest, where can we do it fast, and how can we get these projects off the ground. Now, the other thing is, in many cases, a lot of you are going to start with one building, right? You're going to start with that 10,000 square footer or 5,000 square footer, whatever it is. Maybe outside city limits, county process is going to be simpler. And so, that is what the process looks like. Once you start going past that 10,000 square footer, so let's say that you're now at 20,000, 30,000. There's a whole strategy in place that you need to implement for approvals, for how you're going to build it, which buildings you're going to build first, which units you're going to actually finish out, which units you're not. You have to be extremely strategic because it is a balance, right? And by the way, when I'm giving you all these thoughts of mine and telling you, hey, it's a balance, it's this, it's that, strategically, the way I think is, how do I put the least amount of money in and get the most amount of money out, right? That is ultimately the strategy. That is what has gotten me to this level 11 years out in America. That is what has allowed me to really, be able to now build larger deals and move on to larger projects. If I had not thought that way, I probably wouldn't have gotten where I've gotten in this time. And I know it's 11 years, it's a long time. People do a lot of things in 11 years, but for me, this is sort of my passion. This is sort of almost everything I know. And this is, where I am best and where the network ultimately is the best because of me in making money. Okay. All right. Let's talk about what makes the flex space industry sort of ride high, and what case studies do I have of a recession and how that impacted me in the world of flex. So how many of you in the chat were here in Texas or Houston or in the US in 2016 when we had that mini oil crisis where everybody got laid off in 2016? Do you guys remember that? Does anybody remember that, when oil went to like negative something a barrel and we started getting all of these layoffs in oil and gas? I don't know if I do. I was in Austin then. Yeah, so see, we definitely have people who know exactly what I'm talking about. And I'll tell you what, it was very interesting. 2016, I was in the middle of one of my developments, and I was building Flex, and everybody at that time was panicking. And obviously, I'll go over the rising demand, rent increases, all of that. But I wanna walk you guys through exactly what happened and what that case study looked like. Yes, I was in Dallas, so yeah, we do have people who know what I'm talking about. So I remember I started construction on a flex space development, and remember in 2016, it was not a desired asset. It was nowhere. People did not understand what flex space was. Nobody was looking at flex space. People didn't even know what to call it, and so in 2016, while I was building my flex space development, we went through this huge panic cycle, uh, thousands of layoffs in Houston. And it was really strange because all of those layoffs, they were all larger companies. They all had a comp package, and they all basically got comped, I want to say, from like between 6 months to a year. And so, and that's kind of what that looked like. Also, all businesses came to a standing halt here. And I'm talking about specifically, obviously, oil and gas, right? Because of the price of the barrel, all of these subcontractors were let go. And so it was very interesting because as I was building my flex space, I was getting normal demand from normal tenants, so like my gym guys, my automotive guys, all of that, and all of a sudden, boom, I have all of these oil and gas guys coming in, and a lot of them chose to become entrepreneurs because now they had a package that allowed them to live for like 6 months or a year, and try out, being an entrepreneur. So like I had a guy who started a welding school because he was a welder before he went into oil and gas, and now he wanted to start his own business. He was done with corporate. I had a guy who had a swimming pool company. I had a guy who had a gym. I had a guy who had a jujitsu. Like he did jujitsu, right? He was a trainer before he went into oil and gas as an executive, decided to go back and coach people into jujitsu and stuff like that. It was pretty cool to see all of these guys. Now, at the same time, while these entrepreneurs are coming in, and while these entrepreneurs are flocking towards this FlexSpace development, I also had a lot of subcontractors who were downsizing. So I had subcontractors who were downsizing from 20,000 square feet to 5,000 square feet. I had subcontractors who were downsizing from 10,000 square feet to 2,000 square feet, right? So now they just needed a place to either park their vehicles, or a lot of them actually had like tools, like spare parts for oil and gas, right? Like clamps, nuts, elbows, just bolts, that type of thing. And they needed a place to park it because they had ordered all of this stuff, and now there's no use for it, at least for a short amount of time. Now, the good thing is that everybody knew that this mini recession was like going to be a 1 year thing. It wasn't going to be more than that, and so everybody came to me and said, "Hey, look, you're building these brand new flex space developments in Houston. We want to rent from you." And I would be like, "Hey, I already have another business that wants to rent from me." And they'd be like, "We'll pay you more." The subcontractors would actually be willing to pay me more. Obviously, there were conditions, and the condition is they wanted a short-term lease. They wanted a 1 to 2 year lease, and that's it, because they knew that in 1 to 2 years they would be able to move their product. So in the midst of all this and recessions and layoffs and people losing their homes and people selling their homes, my flex spaces actually became sort of the oil and gas central hub for either entrepreneurs and or subcontractors to come and park their stuff at a premium. And I remember at that time, a lot of my friends who own real estate were panicking. They're like, "Hey, what's going to happen to my tenant? What's going to happen to this?" They owned homes or multifamily or whatever it was. And on my end, I was like, "Guys, what are you guys talking about? Like, it couldn't have been better for me." And so obviously, um, you know, I think at that time, what ended up happening is I figured out that, hey, this thing is literally like recession proof, because someone is going to want to downsize when there is a recession in whatever the business is, right? So whether it's robotics or, whether it's, I don't know, whatever the business is, someone's going to want to downsize somewhere. And when they want to downsize, they're not going to go back into their garage, especially if they are an actual running business. So if they're running business, they're going to need to rent a space. They're going to want easy terms. They're going to want a flexible lease. They're willing to pay. They just don't want to pay that $20,000-$30,000 a month, right? They want to pay that $2,000 to $5,000 a month, and they're good to go. And that is where we come in and we provide them with exactly what they need. By the way, this picture, guys, is my development. It's actually one of my developments. And this is here in Cypress, Texas, when I built it. I built this in 2017 and 18, I believe. Those were the years that this was built. All right. So obviously, what makes it recession proof? I gave you the case study, but I'll go through the slides as well. Rising demand is extremely important. Increasing rent. So this is the unique thing of Flex. Ever since I've been in Flex over the past 11 years now, the rents have constantly gone up, and people are like, ready to lease at any given time, at any given moment. In fact, we have a strategy that basically fills up these flex spaces before they're even complete. So that's what we work with in the flex space network. We teach you how to do that if that's something that you want. And of course, it's a high return on your investment, which is what we're looking for. Let's do a market analysis. Now, obviously, I talked about a lot of different things, and the way I look at FlexSpace, okay, is I categorize my tenants. And why do I categorize them? It's extremely important that you identify which category your tenant falls in, so that you build them the right product, right? So there's three categories. One of them we call the trades, the other we call recreational tenants, and the third, which is the new one as of 2025, well, 2024 actually, is the disruptors. Okay, so you have three classes of tenants: the trades, the recreational, and the disruptors. Now, when it comes to the trades, this is the difference. They don't really care, like, as far as the design element of your flex space, they don't really care too much about it, which means it's kind of good for you because you don't need to overly design your flex space product. This can be a simple metal building with a simple garage door, maybe a metal door that gives them access to the office, somewhere they can just come in, do their work quietly, and leave, right? So what are the trades? Your HVAC guys are trades. Your plumbers and or roofers are trades. The lawnmower, the landscaping companies are trades, right? So these are trades. Your oil and gas service companies are also trades. These are basically people that will go out to the site and conduct their business and then come back in and just either load, restock, and that type of thing, right? Then you have your recreational guys. What are your recreational guys? You have your event managers, you have your automotive shop, you have labs and research facilities. I know that one's a unique one, but they do exist in flex spaces. It's pretty crazy. You have your car wrap shops, boxing gyms, window tinting, CrossFit gyms, indoor gyms, bounce houses. These are all your trades. Now, when you are building for the trades, okay, it's different than when you're building, when you're building for the recreational guys, it's different than when you're building for the trades. Why is it different? Because the recreational guys are willing to pay a little more, but they're customer oriented, which means their customers are actually coming into the flex space to do whatever it is that they want to do. So they're willing to pay you a little bit more, but they need added security. They need a little more landscaping. They may even need a little more glass. And the thing is that you need to do it in the most cost effective manner, because ultimately there is only so much, like there's only really so much you can charge when it comes to rent, right? And so you need to be careful. Well, I can't tell you how many people come in and think like they're going to build the Apple store as a flex space and it's going to rent out. It's not, right? Unless you're in Miami, I would highly not recommend you do that. That's not where most of the money is made. Our product is fairly more simpler, and the way we want you to do it is we want to make sure that it's underwriting so that you have a benchmark of a return. Also, by the way, like between our members, we get to see, because everybody shares with everyone, right? We get to see what type of return other members are making, and then we get to make a judgment according to that. What that allows us to do is get today's information and not lagged information or not mixed information that we're getting from other websites, because as you know, LoopNet is sometimes 2 years behind, not in all cases, but sometimes 2 years behind on their data in certain markets. And other real estate websites are also lagging sometimes. In most cases, I would say data is lagged by at least 6 months. And so in the network, it's live. You actually get to see everything live because people are actually boots on ground and getting to do that every single day. So it's extremely important, obviously, that you have that type of information. Okay. I am a very process-oriented individual. I know a lot of people see me on social media and it seems like total chaos, but that is not the truth, right? The truth is I like to make money, but I also like to have a process where I can look at a project and then give it to my team and tell them, hey, continue on from here. I found the deal. I want you guys to continue and sleep at night and know that I'm going to continuously make money, right? So where does ultimately this process, or rather this journey, begin for you guys? Where does it begin? A lot of you don't know where to get started. Okay, so let's walk over these 5 simple things where your journey begins. And let me walk you through, and I'm going to talk in detail on each one. Identifying site. Sometimes I can't tell you how difficult or how big of a problem it is just to identify the site. Each site is different. Each piece of land is different. This one can't be zoned for this. This one has elevation issues. This one, we're going to have to replace the dirt. This one has too many trees. This one is not square enough. This one, I can't design it the right way. This one, I can't get the 10,000 square feet so that my deal underwrites. This one is going to be 4,000 square feet, so it's too small. And all of those are individual questions for individual people. It is not like there is a generic solution or a generic answer for all of you. You actually need a consultant. You need an individual to walk you through. You may have a real estate agent, and that's great. 99% of them don't really know when it comes to development, don't really know what the steps or the processes are. So this is something that you need to really do. And if you miss a step, guess what? You could end up buying a piece of land and then have either buyer's remorse, because there's other things that are better out there, or it's literally not workable, and then you have to end up now listing the land for sale. In many cases, either break even or pay fees just to get rid of it. In our case, we want to make sure that even before you identify the land, you understand exactly what the processes are, exactly what you need to be looking out for, which county are you in. We want you to have some county meetings, and we show you how to do that. We want you guys to ask the county the right questions. And this is, by the way, even before you put the land under contract. There's a lot of things that we need to check even before you put the land under contract. And I would say, if I had a bucket, 70%, 70, 60% of our members get stuck here. And we need to move them along. We need to be like, okay, all right, guys, this is sort of how it's done. This is what you need to look out for. Come on, let's go. Let's push you along. And this is where we push around 60% of our members. It's crazy. Like site identification becomes a big deal for them. And I know it sounds simple over here as a bubble, but trust me, when you buy a piece of land and you have to replace 3 feet of dirt because you didn't do a soil test, or you didn't figure out, that the dirt was not workable, or it was in a flood zone and you didn't realize, that is very problematic, right? And we don't want any problems. We want you guys to be able to completely move on really nicely, have a smooth process overall. Of course, then I talked about pre-contract due diligence. It's extremely important that you guys start your due diligence pre-contract. We don't want you guys to put a deal under contract and then start your due diligence, because there's a lot of due diligence you can do for free. You can get a survey for free. You can figure out what the county zoning laws are for free. You can figure out what the codes look like. You can figure out if you'll be able to build. You can figure out if there is a SUP, a special use permit. That means if you are allowed to lease to anyone, or does the county restrict you from leasing to certain businesses, to certain trades? These are all things, guys, that you need to be aware of. You need to consciously make an effort, because this is a large investment. This is not, this is something that changed, let me just put it this way. This is something that changed my life probably like 50x, right? And this is something that it could be the same for you. It took me 10 years. It could take you 5 years to do the same. I don't know, could take you maybe 10 years, just like me. It did to me to get to a place where you can do a 30 to $40 million deal on your own and not have to worry about it too much. This is an extremely important process. All right. And just listen to what I said. I said you can do it all for free. Okay. You're not paying $1 to do the due diligence just yet. That is where step 3 of your journey comes in. So now we've done the pre-due diligence. We've looked at everything. It's like, okay, it makes sense. We're going to put this property under contract. This is now where you are going to start paying for some additional due diligence, right? You're going to have to probably pay an architect and engineer to get a chain of title, make sure everything is clean. You're going to have to pay somebody to do a geotechnical and a topographic survey. If you don't know what those are, write those down: geotechnical and topographic survey. You're going to have to pay to get those done to make sure that the land is at the right elevation and that the soil is actually usable for you guys to be able to build, right? But these are all things that take money. We don't want you guys to spend money until we are almost certain that the land is workable, right? We want, like, there's no 100% certainty, because obviously you do need to pay for some due diligence. Not everything can be done for free, or you can't use AI for everything. There are certain things or certain studies that you will have to pay for. And so we want you to pay for them when the time is right. Outside of that, we want to save you guys money. That's the goal. And then, of course, the next step is deal structure. Now you've done the due diligence. Things are looking good. Your site is exciting. Things are looking really great. Now, a lot of people come here and they're like, okay, well, I have a couple of investors. They're all my family. They want to invest in my deal. So I'm deal structuring it. I have a bank that I'm going to talk to, or I don't have a bank that I'm going to talk to. Hey, could anybody connect me with a banker that'll work with me? Hey, I can't sponsor my debt. I don't have enough money. My balance sheet doesn't look good. Is there anyone in the group that'll, or anyone here that will sponsor my debt? Okay, how much do you need to get sponsored? Okay, how do I partner up with you where I can sponsor the debt? So, like, there's a lot of combinations and a lot of ways you can deal structure. You just have to make sure that you do it correctly with the right partners. And you know what? Now that I think about it, I myself have facilitated introductions. Not a promise, not a guarantee, but I myself have facilitated introductions based on a want and a need. So we had an operator who needed cash. We had some doctor investors who had capital. We made the introduction. They ended up investing in each other. They're happy campers. They've done 2 deals together, and things are looking good, right? And of course, finally, the last step of your journey, which is the beginning of your basically development, is the construction, right? Now everything is lined up. You got the debt or you have the cash lined up. Because by the way, we have members that do zero debt, right? They come in all cash and they want to do deals all cash. It just depends on how you want to do them. And so finally, the construction process begins, which is a whole different process that you guys need to be aware of, right? The last thing you want to do is start a construction site or a project and you don't know what you're doing. You definitely want to look at what other people are doing, and you definitely want to surround yourself with other people who are building as well. All right, let's go timelines. What are standard timelines? I think, the people who think that this is a 1 year thing, like I can do this all in 1 year, don't really know what they're talking about. And I'll tell you why. We've cycled through over 600 members, and some of them, okay, some of them, I can count them on my hands, some of them have been able to do a deal in under 1 year. Okay, literally from 600, I could count the members on my hand that can do a deal in under 1 year. Most of them, it starts in year 2. So like a year and a half, a year and 4 months, a year and 6 months, a year and 8 months, sort of, generally what I see is month 13 to month 18 is where the action is happening. And that's when all these deals are getting closed, locked up, and stabilized. Okay, so this is the total process. 4 to 6 months permitting. Have members done it in less? Yes, I can count them on my hand. 9 months construction. That is pretty standard. Weather and whatnot. And then, of course, 60 days stabilization, which means that you will be able to find your tenants and keep them after 9 months of construction. You are completely stabilized. All right. Now, I'm going to go over another process that I created. Sometimes I feel like people need a little bit of a push in order to get things going. Or there is opportunity that knocks your door at certain points. And then members come to me and they're like, hey, Hamza, I got this opportunity. What do you think I should do? Well, let's create a process and see what the opportunity looks like. And what the opportunity looks like is we've created 5 potential exits that you could have. And the reason we've created these 5 potential exits is because the world is supply and demand, right? Just because you're a seller, the reason you're a seller is because there's a buyer on the other end. Otherwise, you would have nothing to sell. If people don't want to buy, you literally have nothing to sell. But luckily for you and for me, people are willing to buy projects at any given phase. So let's walk you through that. I've seen many cases in which members do land arbitrage. They found a land that's like really cheap. They bought it for like $50,000 or $100,000 or $500,000, and it's worth, like, on the other end, it's worth double, right? So they come to me and they're like, hey, I got offered $800,000 and I only paid $400,000 for the land. What do you think I should do? Well, I think you should sell it. Why not? You've mitigated risk. You can take that 400,000, put it back in another deal, and hopefully get that second deal built out. Nobody is holding anybody forcefully to hold on to your deal until stabilization. It's just you have to see a time value of money, and you have to see how much money is enough money for you and when you are ready to move on and move along. So definitely something to look at, definitely something to consider, right? A lot of people are coming in and they're just literally buying land and selling land until they have enough money or enough capital to do their first ever FlexSpace deal and get that cash flow, get that monthly gold is what I call it. Okay, so that's your first exit. The only way you can do these exits if you are in the money at every phase. That means you are making a profit at every phase. So this does a few things for me. I know that by the time you got to your stabilization phase or the stabilized exit phase, you are already making money because you said no to all the other phases when you were offered a potential return on them, right? So what does that look like? then you have your number two. So number one is obviously your land exit. You bought the land, someone offered you more money for it. You have the potential to sell it. Let's say you don't want to sell it. You're like, nope, I want to make the bigger dollars. I'm gonna do something else. All right. Then you have your preliminary exit. Now what you've done is basically you've bought the land and you've done some preliminary due diligence. You've done some preliminary documentation. You have letters from the county. You have letters from the utility district. You have letters from the municipality that, hey, we're going to allow you to build flex. So now you've taken out some of that risk for the next guy. And now you want to sell the land. Well, guess what? All that due diligence you did, you can add it on, you can tack it on to the land price, because now another FlexSpace buyer can rest assured that, hey, you did a little bit of the work, and all they need to do is now do their architecturals, engineering, so on and so forth, and they're going to get ready to move that deal. Okay, let's say you decided not to exit at the preliminary phase, and you're like, you know what, I don't want to exit here. I want to make a little more money, and I'm going to get this deal shovel ready. I would say most of my deals personally sell at this phase, either shovel ready exits or phase out exits. And I'll go over that in a second. There's a lot of people, a lot of funds, a lot of investor groups that don't like taking what we call permitting risk. And they're willing to pay a premium for this permitting risk. So Hamza, sell me a deal. I don't want to take any permitting risk. Give me the permits. I'll pay you X amount of dollars over what the price of the land is, because I know you did all the work. You waited the 4 to 6 months, and you got this thing permitted, and you made sure everything is in where it needs to be. So all I need to do is come in and build. I don't want to take that permitting risk. If you paid $100,000 for your permits, which you saw earlier that I did, we'll give you 250,000 or another additional 100,000 on top of that, plus the profit on the land, and you're good to go. All right, perfect. Thank you very much. I appreciate that gesture, and I decide to sell. But you know what? Also, I can decide not to sell. So it depends, right? It depends on what is being offered and what that money really means to me. Now, if you do not sell a shovel ready exit, the next step is your phase out exit. What's a phase out exit? We have a very unique situation with these flex spaces where we can actually build them in part, get them leased out, and then sell them. We don't need to complete the entire development. The way it works is very easy. You don't really restrict access to anything. A bigger developer is going to come in and take over the deal when the time is right. So let's say, for example, I decided to build, I don't know, 10 buildings. I built 2 or 3, and a developer came in and said, hey, Hamza, here's a check, right? For the 2, 3 buildings, plus this improved land that you improved, and we will continue construction from here. Okay, sure. I actually sold my last development this way. It was a total of 11 buildings. I built 4 and then had a massive exit after that. And then, of course, finally is the stabilized exit. This is when you are saying no to everyone because you want to make the most amount of money. And this is where you make the most amount of money, because let's say you completed the 10 buildings and now you leased everything. You're going to sell at a cap rate. And when you sell at a cap rate, that is generally the most amount of money that you will make per development, per building, or per project rather, depending. If your project is 1 building, 2 buildings, whatever it is, this is, I think, ideally where you want to make the most amount of money. And of course, the bonus exit is you just hold the deal. You just cash flow the deal all the way to the bank. It is the least problematic asset you will own. You will really enjoy the ownership experience. No problems, no headaches, no stress. And that's kind of sort of what we like and what we look for. All right. Let's do a real quick case study. And I want to show you one of our members' developments. Now, this member, 2 things cool about this member. She was based out of California, and she actually built this deal in Alabama. So out of state, she found herself with another member, and they decided to go on and build this deal, this specific deal. This is an actual deal by one of our members in the FlexSpace network. So pretty cool. I would say pretty cool looking deal. Obviously, the colors and the color theme is something that we individualize. There's a few things that you'll notice is, look, this is street facing over here. So there's a window that we had them install. We also had her put a little bit of glass, and we had a small awning that we recommended that she put. Project was complete. She did fairly well on the development, and it looked absolutely phenomenal. This development, by the way, right now is complete. So it is complete. It's fully occupied. It's fully stabilized. It's multiple buildings. And I believe she's moved on to another development or to her next development. As part of our FlexSpace network, she completed about 3 developments with us before she graduated. And now we often keep in touch, and we sort of, monitor her developments from afar. If she ever has any questions, she jumps in, and we can answer those for her. Because, if you're developing in 2016, it's different than if you're developing in 2018. Once again, it's different than if you're developing in 2020 or 2025. You need to come back. You need to make sure that, what you learned in 2020 is still applicable, because a lot of things change. And for example, one of the things that changes, when we first used to build these, we used to put 12 by 12 garage doors, or 12 by 10 garage doors. Those are no longer applicable in the world of flex. You actually need to go higher. Okay. All right. So in this case study, this member specifically joined FlexSpace in October 2022, found the land in January of 2023, closed on the land in May 2023 once again, and then permit August, and then in 2024, so from May 2023 to August 2024, this is sort of when this development took place, and she was able to get it 100% occupied. Obviously, after that, she began the phase 2, and then she has completed that since then, and has now moved on to different deals. So deal stats. I know you guys want the numbers. You guys want to see what they look like. So I'm going to show them to you. This is obviously with her permission. She has allowed us to use this as a case study for you guys. Okay, so thank you to her for sure. And by the way, we have a ton of these case studies within the network. So you get to see, I would say at least a couple of these a month. And we get to analyze numbers. We run them all together. We make sure things are looking good. And then we approve, we give them the nod as best we can to tell them, yep, go ahead, build it. It's looking good so far. All right. So total land size rather is 4.3 acres. She's building 5 buildings, so that comes up to around 55,000 square feet of 11,000 square feet each. 90-10 ratio, which is very typical, and then building coverage is 29.36%. The building coverage of your land is extremely important. We want you guys to be within a percentage. And that percentage, I'll just give it to you right now, is 27 to 32% is where we want you guys to be of your total land, right? So if you have 187,000 square feet and you're building 55,000 square feet, that's sort of in the parameters of where we want you guys to build. So definitely something important. And these are just like minute details that we look at when assessing a deal. We want to make sure that you're doing things correctly, because the last thing you want is to make one mistake. How many of you know what a mistake in real estate development will cost you? One mistake, just one mistake in real estate development. What do you think the cost of that mistake is? Put a number down, whatever you think that number is. I've actually had a bunch of these on my developments. But what do you think the general average cost of a mistake is in real estate development? I'm just curious to see what you guys think that number would be. Okay. So let's go over this. Obviously, she built this in phases, okay, because she couldn't sponsor the debt one go, so she built it in 2 phases. So obviously, in the first phase, things are a little more expensive, and because you're doing more, right? You're building the infrastructure, you're building the underground. In some cases, you're putting in more doors. In some cases, you're doing more things. So obviously, phase 1 is always more expensive. So let's go over that. Phase 1. She wanted to build 22,000 square feet. The cost that she assumed was 2.6 million. It ended up costing her 2.9. Carry cost, she assumed 100. It costed her 119. Down payment for her development, because it was a larger development, she put down 795. By the way, this was because this was a phased out development and they knew that. So total cash was roughly around $914,000, right? Price per square foot, $138 versus the $125 that she had assumed. Loan amount did not change. As you can see, her loan amount was $2.116 million, and then her interest rate was $8.15 million. The yearly debt service was $172,000, and the rent, by the way, the rent that she assumed was $14 a square foot. As you can see, she actually beat that number and got $15.05 a square foot. So her total revenue jumped from 308, which was her assumption, conservative. I always say better conservative than optimistic. And so she was conservative, and she got 331,000 instead. And what that did is her NOI, if you look at it over here, it was 256,000. It became $275,000. Okay. Total phase one estimated value is what she had assumed. So remember, the cost was what? The cost was basically the debt and the equity and maybe the debt service. And so she assumed that she was going to make $3.6 million, or that was going to be the value of her phase one. It ended up being valued at roughly around $4 million. And the cash flow, so the cash on cash return was roughly around $103,000. Now, obviously, the cash on cash went down here because her expenses were a little higher, but her income was higher as well. Now, this is where the fun part begins, guys. When you have a project that you build in phases, and the reason I always recommend that you build in phases is, yes, phase one is a little more difficult. Yes, you're only utilizing a small piece of the land. Yes, you might only be building one or two buildings. But the cool thing is, is that the phase one then carries the phase two. So you're not really putting any more money into the deal. You're done putting money. You're refining the same phase and the cash flows of that phase in order to be able to build your next phase. So this is the coolest thing about phase out development. I think everybody should be doing this. In fact, I do this on all of my developments. It doesn't matter what the cost. It just increases the return and makes it significantly higher. Now, if you look at the return, guys, what is the investment? The investment is the $914,000 that she put, right? Now, guys, I know I'm putting $914,000 in this case study. You can round this up to whatever you want. So you can make it, I don't know, $2 million of cash, or you could make it $200,000 of cash. I'm just giving you an example as to what a phase out development of this caliber looks like and what you should expect to see when it comes time for your own development, right? So obviously in this case, she had to put no money down, right? And she got, now her new cost ended up being 5.9, let's just say $5.85 million. Her price per square foot dropped significantly because all the improvements that she did in phase one to get the development going no longer needed to be done, right? So she put those extra roads, she put the fire lanes, she must have put the detention pond, she did all the underground and the utility work. Guess what? None of that had to get done. And so as a result, the cost for their phase two or to stabilize this asset was significantly lower. Total loan amount 5.196. Also, guess what? Interest rate at that time went down significantly. Loan type obviously was interest only. This was the debt. The gross income was $825,000 after you subtract expenses. Her cash flow was $309,000. Okay, and this is passive. And by the way, think about it. She put $900,000 down, cash. Cash flow from the deal is $309,000, right? So just look at that. That's pretty crazy. That's pretty crazy stuff if you build the way she built in phases. Very, very good. All right. Also, I want you guys to see something. Total loan amount was $5.19 million. Okay. And plus the $1 million that she put. So that's around $6.2 million total cost on her. Maybe actually, let's add the debt service. So instead of 6.1, you're looking at about a 6.5 million dollar cost, right? Over here, this, by the way, was provided by her, and she's actually doing better than these numbers, but this was provided by her at an 8 cap, which brand new deals don't trade at an 8 cap. She's making $9 million. Her profit from 6.5 to almost 9.5 is $3 million right here. She could be selling for 10. Obviously, when we ask you guys to underwrite, and you work with one of our coaches to underwrite your deals, we ask you guys to present scenarios because there's no fine number, right? Just because my market is a 6.5 cap doesn't mean that your market is a 6.5 cap. Your market could be a 5.5 cap, could also at the same time be a 7.5 cap. So we want you guys to run scenarios so you guys understand what your return will look like. And in 2027, her anticipation is that on the most, she'll be sitting on $11.5 million, guys. minus the 6.5, which was the cost. That's what, $4 million, right? 11.5. Actually, no, 10.5 would be four. So $5 million with an initial investment of $914,000. Okay, so you take that, either add a zero, remove a zero, whatever you need to do to make that math work for you. This is the type of return that you can make if you just take action, if you just get it done. Uh, and this is sort of how that ends up working out. Okay. Let's talk about funding your flex spaces. Obviously, there's a lot of ways you can fund your flex spaces. I want to talk over a few of them. You can JV either with other members or people within our network. Sometimes we host events in our office where we bring together a couple, like a lot of people that'll come and talk and do business and all of that. As members, you're more than welcome to attend those. But the idea here is joint venture partnership is probably the easiest way to get things done and to get things started. You're willing to do a part of the work, you have part of the money, you need somebody else who can sponsor the debt, who has a balance sheet, or whatever it is. Like, whatever the JV situation is, whatever the partnership situation is, I think it does end up working out very well for everybody who is in the process, like in that deal. Right now, I can say a lot of our members have JV'd, a lot of our members have partnered. We have yet to see a failed marriage. So all of our marriages, or all of our partnerships rather, are pretty successful, and we're very happy with the way things are going with those. Obviously, no promises. If you are a member, if we have someone who's looking for something, or if you're missing something, we will facilitate an intro, but you have to do the work beyond that, obviously. Um, Another way to fund your deals are syndications, right? Syndications are setups where you have an operating partner who's literally just looking for capital, doesn't want anything else, and finds investors who believe in him or her and are willing to give you the capital that you need in order to make this development a success. That is typically what a syndication is. There are many types of syndication. So a syndication technically is still a fund, but it is a fund. It is what I would call a laxed fund. So it's a little more, laxed, and hopefully now with the new guidelines that are about to come out, it's going to be even more lax, is what I'm hearing. And it basically promotes people to become general partners and go and look for investors to build these type of developments. So that's going to be something awesome. It's going to happen pretty soon. Ideally, in these scenarios, there's two types. There's one, there's a type where you can get money from your friends and family. There's a type of setup. And there's another one where you only are allowed to go after accredited investors. So well, in both cases, you're allowed to go after accredited investors. One of them does add friends and family in the mix, but it has some limitations. Most of the people, I think, go for the one where you have to go after only accredited investors, but you are allowed to solicit as well. So definitely something that you want to see. You want to make sure that you are pulling together the capital in the right way. By the way, speaking of, we actually have an attorney who is also one of the coaches in the network, and he probably guides all of our members on what they need to do. He's not an SEC attorney, so he doesn't set up syndications or funds, but he works other ways through partnerships where it's much more cost effective for you guys to take capital from investors. So definitely something to look at and consider. All right. A lot of people ask me, Hamza, oh, wow, amazing. You talk about these $30 million projects and you talk about, all these big deals and whatnot. What is the bare minimum? And there is a bare minimum. Remember, I told you guys I came here with a couple $100,000. Um, and that is what I expect. Does that mean you have to have the money in your bank account? No, but you have to have access to it. You have to figure out a way to get the money, because the money is what is going to sponsor the debt, is what is going to allow you to be able to build your first development, right? A lot of people say, yes, I have access to money. Well, perfect. It's my family. That's great. It's my friends. That's great. I can pull together a couple of my buddies and we'll come up with money. And that is awesome. How much do you need? I would say at bare minimum, guys, this is bare minimum. You're building one building, like it's, a really small development. Um, you probably need around $330,000 to build something brand new. Now, This being said, I'm calculating the price per square foot at $110. Obviously, you could build it for maybe a little less if it was like absolutely bare bones and if you were in like a secondary or tertiary market. But I would say these are generally in line with most of the members that I work with within the FlexSpace network, or most of the members that come to us within the FlexSpace network. So building is about 10,000 square feet. It costs about $1 million to build the 10,000 square feet, which is roughly around 110 for the building. Obviously, there are soft costs, hard costs. Hard costs are 103, and then there's soft costs, which is your engineering, architectural, or whatnot. And obviously, then we have the criteria for the land. Now, the land, this is interesting. And I know it says less than $5 a square foot. That is not really the case all across the country. Obviously, if you are in some parts of the country, maybe $2 a square foot is too much. But if you're in other parts of the country, like Philly, and in the Northeast specifically, $5 a square foot is not going to get you much, and we understand that. So or parts of California, so we understand that, and we know that you need to go higher. But that is then discussed on a case by case basis. We need to actually see the land, do the due diligence, and then you tell us what you're willing to pay for it, and we'll give you our opinion. Outside of that, I would say stick to the less than $5 a square foot if you're not in one of these unique markets, and you will be pretty safe when it comes to your development. Obviously, finding the right land, I do have a process that I created. It's called land gridding, and it basically cuts land into 4 quadrants, and then we do a little more due diligence into each quadrant. What I like to do is I like to cut and slice and dice the land based on the hour hand. So every slice is like an hour. And then we do due diligence in the middle of the hour. The reason I do this, guys, is because, and I'll tell you why, everyone comes and asks me, hey, Hamza, where's the best place for me to find land in the country? In most cases, in 8 times out of 10, it's your backyard, right? But you have to make sure that you're looking in the right place in order for you to find it. And most people are comfortable building closest to them, somewhere that is in arm's reach, somewhere that you can drive the property every single day or whatever it is every single week. I am comfortable not visiting my sites anymore, but it's been 11 years I've been doing this. So I have my ways. We have members that really don't want to visit sites, hire reputable general contractors, and they're done with the process. But for a lot of us who are just starting out, we actually do want to visit the site and make sure things are looking good. And it's totally understandable. Nothing wrong with that. Nothing, first development. When I did my first development, I was there every single day. So totally understand how that's done. Finding the right land. How do you do that? Obviously, I'm gonna write down I'm gonna speak about these methods. Driving around, so you can drive for dollars, or work with wholesalers. The way I like to do things is I like to actually go into Facebook groups and discuss and look at my Houston real estate networking group or commercial real estate group or whatever it is. Find the most active real estate agent or the most active person in the group, reach out to them and see if they can find me land. That's usually generally the way I look for land. I look for the most active people in these groups because they are generally people who can help me with what I want because they are the people who are most active. Obviously, you can drive around. Like I said, you can use LoopNet, you can use Crexi, you can use other websites that are available. You can also talk to brokers. Brokers are a great resource. I wouldn't say, the thing is with brokers, you just need to be careful because they are there to sell the land. They don't necessarily have all the information that one would need in order to sell it. So you just need to make sure that you do your due diligence on top of the broker's due diligence. And as long as that is done, nothing wrong with that. Then, of course, you can network. You can network your way into anything, I think. Anything you want, you can definitely network your way in. And finding land is no exception to that. And then you can niche down. One of the things you do need to do is you do need to niche down to FlexSpace only. That's sort of what I look at. I don't look at land that's good for anything and everything. I'm more specific to FlexSpace. I think, with FlexSpace, sometimes you can get away with no street frontage. You can get away with certain things that you can't with retail, right? You can get away with more parking. You can get away with a narrower entrance to your lot. You can get away with not really a squared lot, but a thin, longer lot. So it just really depends. Once you start niching down for FlexSpace only, your options really do open up and you do get to see exactly, why other people are not able to operate in the same space. It's because they were probably looking at putting, I don't know, office building or multifamily or single family, and it just didn't work. Well, guess what? All of those deals work for us in the world of Flex. And ideally, I would like utilities to be available. Now, this is something that we do look at in the pre-due diligence and the due diligence phase, and I would recommend that you guys do that as well. Make sure you have, depending on where you are, if you are where it snows, you're gonna need gas, power, water, and sewer, right? And of course, the drainage, right? Rainwater. If you are not where it snows, if you're in a place like Houston, Texas, then you need power, water, sewer, and also then drainage. So those are things that you can avoid gas, but you need all the other things. Now, in many cases, we find land in the middle of counties where it's septic or well or whatever it is. Guess what? Flex spaces love well and septic. They are not used often, but they're pretty good, right? So we are friends of well and septic. We are not enemies like other asset classes because the usage is very minimal, and it's not that much of a cost. Obviously, you do lose a little bit of real estate, but that's okay as long as the deal works. Remember, guys, in the very beginning, I told you guys, it's not about where you are, it's about if your deal is going to work. And what we want to really see is we want to see your deal make money. We have a benchmark. Our members make a ton of money. We want you to be one of them. We don't want you to miss out, make silly mistakes, and then lose out on potentially a 5x or a 4x or a 3x or 2x return on your money with your development. And then we actually do want to see you guys complete your first development, because that is what helps you move on to your second development, which then becomes even more fun than your first one. Trust me, I've been doing this long enough to know. And then, of course, the minimum of 1 acre is so that you can build that 10,000 square feet. The 1 acre is extremely important. Ideally though, write this down. Um, Ideally, if you are looking for land longer term and you want to build, multiple phases on it, 3 acres is sort of the sweet spot. 3 acres, you can put 3 to 4 buildings on 3 acres. So that means you can build one building, then you can over time build another building, you can build a third building, you can build a fourth building. And the best part is you don't need to go hunting for land every time you're done, right? You have a land that'll work with you for as long as you want, right? So 3 acres is sort of ideal in my mind. All right. So one really quick thing, we have the QR code up for you guys. If you are interested in joining our network and becoming part of the 600 plus people that we have helped make serious amount of money, and I'm talking serious amount of money, um, please either scan the QR code. I would say scan the QR code, sign up with someone on my team. If you have already signed up with someone, by the way, I'm gonna take questions in just a second, okay? So if you have questions, type them in the chat right now, and we're gonna do rapid fire. I wanna answer your questions. I wanna see what interested you in Flex, why are you here, and how we can better assist you. So if you have questions, go ahead, ask them now. If you do wanna book a call, highly recommend you click that QR code, get in touch with my team, become a part of my network. Let's make sure that you are taken care of, number one, by making the right amount of money, and number two, by not making mistakes. Trust me, guys, it's not worth it. You make one mistake, uh, that's going to put you behind way more than you think. And ideally, that's what we want you to avoid. I know a lot of you aspire to become developers, and I aspire to help you become developers. Uh, but let's try to avoid mistakes together if we could. Okay. Now, if you want to go make them on your own, go make them, man. I'm not going to stand in your way. But if you don't, then definitely click the QR code, and let's get answering those questions. What do you think, guys?
Hamza, I have a few questions here for you. And guys, just a reminder, once you click on once you take a picture of the QR code, follow through with the form. Those details are important for us. We would love to answer all of your questions and more. It will be me and Lance or Tiranu. One of our team will be in touch with you guys once you book that call, and we'll look really forward to it. A few questions for you, Hamza. Are FlexSpace zoning requirements usually about the same for typical warehousing or like storage units? Is the zoning
No,
similar?
no, they're different. So flex spaces are unique. They could, so storage could be one of the zonings, but then you are only allowed to store, you're not allowed to run a business. Ideally, FlexSpace operate in, I would say, community commercial, light industrial, heavy industrial, unrestricted. Um, and I think more important than the zoning, there's also one more that they operate out of. But more important than the zoning, guys, is you want to actually talk to your county. So let's forget the zoning for a second. Talk to your county and just ask them, hey guys, I'm looking to build a flex space. Do you have any SUPs for that? Special use permits, or is it unrestricted? And if they tell you, hey, our SUPs, we have SUPs, like we have a special use permit, like only certain types of traits are allowed to build, occupy this area because of this land. Well, guess what? You get a pretty good idea as to what type of flex you need to build, whether you need to build a retail type flex for your recreational guys, or you go with the trade style flex where other businesses can operate. Remember, the zoning is different than storage because you're not only storing, these are operating businesses that come in, come out on a daily basis. There is a stricter fire code. So definitely not the same, but it's a similar process. Yes.
Another question, Hamza, what's usually covered under the triple net lease costs wise?
Everything is covered. So you should have your taxes, your insurance, your maintenance covered. Your triple nets are generally $3 to $4 a square foot, guys, just so you know. That should cover most of your needs. Now, if you have common area, if you have excessive common area landscaping, if you have excessive, or if you don't have individual water meters, that is something you're going to have to bake into your lease. But outside of that, your triple net covers basically all the things that triple net covers. In most cases, I would say, guys, additional to your triple net, what you're not going to have is you're not going to have individual meters to individual bays. It's going to be one, and when I say meters, I mean a water meter. So either you're going to put a sub meter for your water, so you can come in and see how much each tenant is using, or you just tack on a monthly fee for each tenant as long as they don't use water. And if they use excessive water, or if their business uses excessive water, you want to make sure that you're charging them the fee accordingly.
Amazing. And what is the average height everyone is building their flex space buildings at?
So I would say it really depends, and I know it's a broad answer, and I hate saying that, but it depends on if you're putting a mezzanine, who your tenant profile is. If you're not putting a mezzanine, this is how I build mine. If I'm not putting a mezzanine, it's 16, 21, 16. So it's a what do you call it? It's like a dual slope flex space, and it'll be 16 feet, 21 in the middle, and 16 if I'm not putting a mezzanine. If I'm putting a mezzanine, I'm going as high as 30 feet in some cases, just depending. My latest project, for example, I'm going 30 feet. It's single slope. It's gonna go, actually, I believe it's 27 feet and it goes down to like 24 feet or
Yeah.
23 feet. And so that's how the slope is. So it just really depends. Who's the tenant?
Some traits like landscapers have trailers. Do you allow a certain number of parking spaces? And do you charge for additional parking?
Yeah, so generally we don't charge for additional parking. We do have tenants that have a lot of trailers sometimes. Generally, what you want to do is you don't want to cram like two 1,500 square footers right next to each other that are dense on parking because they're going to end up fighting. So if you have, let's say, like a tenant that took 4 bays, usually those tenants don't use all of their parking or don't utilize all of their parking. I would put somebody who has excessive trailers or whatever next to them. Or sometimes what we do is, because we have detention ponds and we have some irrigation like spaces. I will give the guys who have excessive trailers that area so that they can park them there somewhere. Now, I will say generally, like for example, in the landscapers situation, their trailers are not on site for a long time. And what do I mean by that? They come in early in the morning, their trailers are gone, and then they come in the evening to park their trailers back, right? Because they go out and they cut grass and they need those trailers to do that. So landscapers, I would say, are probably pretty quiet and busy tenants. Their trailers are not really sitting on site, at least not in the times that normal businesses operate because they're on site. Now, if you have a business that's like collecting trailers, I would avoid that type of business altogether, because that just makes your flex space look not good, right? Unless you have excess parking. But no, we don't generally charge for excess parking. That's not really a feature that we've added on just yet.
Yep. And in the research phase, prior to building, we usually figure those things out and build
Yeah,
it.
that is true.
And last question, Hamza, as we are running out of time, is it reasonable to step into a project that already has permits and drawings made for FlexSpace? Can FlexSpace Network help with a project that already started? Maybe, yeah, that's the question from Jim.
Yeah, absolutely. I mean, look, ultimately, you don't know what you don't know, right? And we consult, the membership is for everyone and anyone who sort of wants to understand what is going on at every step of the way. Now, if you feel like you know everything and you're not going to make even one mistake during your construction phase, that's fine. Like, let me give you guys an example, right? Like, we have members that come to us with drawings and they're like, well, this is all built out and it's all done. We can actually take a look at those drawings, and sometimes if they've not been approved, right, we can go like, okay, could you change these like few things based off some due diligence that we've done? Or if they have been approved, in some cases it's not worth going back and making the changes, but we can do what we call on-site changes, right, which are like very minor changes to make things a little more efficient. Also, if you want to understand, what things are costing, who people are using, all of that, you're not really going to get to do that outside of the network. I think we're like, I want to say this with excitement, we're like sort of one of a kind when it comes to the network. And hopefully you take the learnings from your first one and you implement them on your second one, right? The good thing about FlexSpace developers is nobody actually stops at one. People who build their first one successfully go to the second one, and the second one definitely does change significantly, and efficiencies come through. You know, quite they become quite more efficient on the second deal. So it really just depends. Who was the guy who asked that question, Jim?
Yeah.
Is that his name? Okay, so yeah, I would say, Jim, look, uh, it's a place where we all discuss strategies. You're gonna need to lease, you're gonna need timelines, you're gonna need so many different things outside of the actual development. You're gonna need to stabilize the asset. And the fastest way to do that is to see what we are doing on the inside, because that's really something where we really, really help our members understand.
And just before before we close, just a last question. There's a lot of questions. We would love again to get in touch with you guys. We can answer all of those questions, me, myself, or Lance, and carry on the conversation with you guys. Just a last question. Do you recommend lease and hold or better to sell after build out?
So actually, that's a very
Yeah.
long. I actually have to draw a roadmap to explain to you why I specifically sell all my deals and what that has allowed me to do over the course of 10 years. I have this journey of mine that I map out for all of our members, by the way, when we have a discussion, and it seems to blow their mind on what big differences are between leasing and selling. And obviously I sell. I force the appreciation, get out of it, move on to the next deal, as long as there is a next deal to move on to, right? Now, what I would say is that in itself is probably a 1 hour conversation. So it really depends on your goals, on where you are in life, on what you want. But I can definitely share my perspective and what I have done and what that has allowed me to do. Unfortunately, those are things that I only discuss specifically with the members.
Perfect. Well, it was a pleasure, everyone. Again, we want to get into all of your questions and answer all of them on a live call with you guys. So go ahead and book that QR code. If you don't have a camera on you, you can just take the link from the bottom left side of the screen and just type that into your
Why don't you do this? Why don't you type the link in for them in the chat so that they can just click on it? Or is this
uh,
or is this the
thing is, I can't send the chat. Lance, would you be able to type the link as a question so we'll just make it more convenient for everybody?
Let me
Thank you,
see.
everyone. It was good having you as well.
Yeah, it was great seeing you guys. Definitely, like Karim said, for sure, with the QR code or the link, whatever it is, have a conversation. See if this is a good fit for you. I'm sure it will be if you're serious about building or becoming a developer at some point in time. And with that, I'm gonna say good night. Go have some dinner, guys. I'm gonna go have some dinner now and play pickleball with my son. But go have a good time, and we'll see you guys on the other side. Take care, everyone.
Thank you.